In recent years, the intersection of psychology and economics has birthed a powerful new discipline: behavioral economics. Unlike traditional economic models, which assume that individuals are rational actors who make decisions purely based on logic and self-interest, behavioral economics acknowledges that human decisions are influenced by biases, emotions, and cognitive limitations. This shift in understanding has had a profound impact on the world of personal finance. By examining how and why people make financial decisions, behavioral economics is transforming the way individuals manage money, save for the future, and invest wisely. This video explores how behavioral economics is revolutionizing personal finance, focusing on areas like saving habits, spending behavior, investing, and debt management, all while providing actionable insights on how individuals can improve their financial well-being by understanding their own psychological tendencies. Behavioral biases in personal finance. Behavioral economics reveals that people often fall victim to cognitive biases that can negatively impact their financial decisions. Some of the most common biases that affect personal finance include present bias. People tend to prioritize immediate rewards over future benefits. This leads to poor financial decisions like overspending today at the expense of saving for tomorrow. Loss aversion. This bias refers to the tendency for individuals to feel the pain of losses more acutely than the pleasure of equivalent gains. In personal finance, this often results in overly cautious investment strategies where individuals avoid taking calculated risks because they fear losing money. Anchoring. Anchoring refers to the human tendency to rely too heavily on the first piece of information received, the anchor, when making decisions. For example, a person might decide not to purchase an item on sale because they are anchored to the original price, even though the discounted price is still higher than comparable items. These biases demonstrate that even small cognitive errors can lead to significant financial mismanagement. However, by being aware of these tendencies, individuals can take steps to counteract them. The role of defaults in financial decision-making. One of the most powerful tools behavioral economists have discovered is the power of defaults. When individuals are presented with a default option, they are far more likely to choose that option, even if it may not be the best for them. A famous example of the power of defaults is in retirement savings. In many companies, employees used to have to opt into their 401k retirement savings plans. Behavioral economists found that participation rates were much lower when people had to take action to enroll. When companies switched to automatic enrollment, where employees are automatically enrolled in the plan and have to opt out if they don't want to participate, participation rates skyrocketed. This shift taps into people's natural tendency to stick with the default option and has had a positive impact on personal savings behavior. Nudging people towards better financial choices. Nudging is a core concept in behavioral economics and refers to the idea of subtly guiding individuals towards better decisions without restricting their freedom of choice. In personal finance, nudges have been highly effective in encouraging people to save more, invest wisely, and manage their spending. For instance, apps like Acorns use behavioral nudges to help people save without them even noticing. The app rounds up users' purchases to the nearest dollar and invests the spare change. By making saving automatic and effortless, people are more likely to accumulate savings over time, thanks to the small nudge of rounding up their everyday expenses. Governments and financial institutions are also using nudges to encourage better financial habits. For example, the UK introduced a Save More Tomorrow program, which asks people to commit to saving a portion of their future salary increases rather than their current income. This taps into the concept of present bias by deferring the pain of saving to a future period when the individual expects to be wealthier, making it easier to commit to long-term financial goals. Behavioral insights in debt management. Debt is one of the most stressful financial burdens many people face. Behavioral economics has shed light on why individuals often struggle to manage debt effectively. One significant finding is that people tend to focus on the size of individual payments rather than the total interest paid over time, leading to suboptimal decisions like paying off smaller debts with lower interest rates first, instead of tackling high-interest debt. Tools like the snowball method and avalanche method have emerged as a result of behavioral insights into debt repayment strategies. The snowball method encourages individuals to pay off the smallest debts first to gain a sense of accomplishment and motivation, while the avalanche method focuses on paying off the highest interest debts first to minimize overall costs. Both strategies aim to counteract the psychological hurdles people face when managing debt and offer structured ways to tackle what often feels like an overwhelming financial burden. Improving financial literacy through behavioral economics. Financial literacy has long been touted as the key to better financial decision-making. However, traditional approaches to financial education have often fallen short because they assume that simply providing more information will lead to better outcomes. Behavioral economics, on the other hand, emphasizes that information alone is not enough. Individuals also need systems and tools that account for their cognitive biases and tendencies. For example, personal finance tools like Mint and You Need a Budget, which are crucial for overcoming biases like present bias and over-optimism about future financial behavior. Behavioral economics in investing. When it comes to investing, behavioral economics has transformed the way individuals think about risk and reward. Traditional investment advice focused on rational decision-making and efficient markets, but behavioral economics has shown that individuals are often irrational when it comes to investments. One of the most famous biases affecting investors is herd behavior, the tendency for people to follow the actions of a larger group, even if those actions may not be rational. This can lead to market bubbles, where investors drive up the price of assets simply because everyone else is buying, not because the underlying value justifies it. Helping investors avoid the common pitfalls of overreaction, fear, and greed that often result in poor investment choices. Additionally, target date funds have become popular due to behavioral insights. These funds automatically adjust the asset allocation from more aggressive investments to more conservative ones as the investor approaches retirement age. By automating the rebalancing process, target date funds remove the need for investors to make complex decisions, helping them stay on track for long-term financial goals. Future implications of behavioral economics in personal finance. The influence of behavioral economics on personal finance is still in its early stages, but its potential is vast. As financial institutions, app developers, and policymakers continue to embrace behavioral insights, we can expect even more personalized financial solutions that cater to the psychological and emotional needs of individuals. One promising area of growth is in personalized financial coaching powered by artificial intelligence. By analyzing a person's financial data and behavior patterns, AI tools can provide customized nudges and reminders to help them stay on track with their financial goals. This approach combines the power of data with the psychological insights from behavioral economics to create tailored strategies that enhance financial well-being. Thanks for watching. If you enjoyed learning how behavioral economics is changing personal finance, make sure to like this post and subscribe for more valuable insights on money management. Don't forget to hit the notification bell so you never miss out on our latest updates. See you next time.